Good morning. My name is Bill Ryan, and I am representing the PCAOB's Division of Enforcement and Investigations this morning. And I, too, will start out with this disclaimer. The views I express are my own and they do not necessarily reflect those of the board as a whole, any individual board members, or other board staff. I have the privilege of working with the division's highly dedicated and talented accountants, attorneys, and other professionals serving the board's goal of protecting investors. The division is authorized to investigate registered public accounting firms and their associated persons for noncompliance with the Sarbanes-Oxley Act of 2002, with the rules of the board, the rules of the Securities and Exchange Commission, along with other rules, regulations, and professional standards governing the audits of issuers and brokers and dealers. We use our investigative authority to identify potentially serious audit violations and other potential violations of relevant laws and rules that pose significant risks to investors. And when investigations reveal that auditors have run afoul of their professional obligations or have threatened the board's regulatory oversight processes, the board, to demonstrate that noncompliance with rules and professional obligations, auditors who engage in those violations will face real consequences. The board uses its disciplinary authority. Our goal at the end of the day is to deter non-compliant auditors and others similarly situated from violating applicable rules and professional standards. To go over what I'm going to cover today, first I'm going to talk about the enforcement program and its statistics for 2024 and 2025. Next, talk about the range of potential sanctions and the effect of suspensions and bars on individual auditors, and some consequences of allowing barred or suspended auditors from associating with registered firms. Next, I'll turn to the current outlook for the board's enforcement program. Then I'll turn to matters involving quality control and a particular aspect of quality control, preventing or failing to prevent or detect auditors from engaging in what we call exam sharing or improper exam cheating. Next, I'll turn to our coordination with the Securities and Exchange Commission and other regulators, including non-U.S. regulators. And I'll end by talking about some recent noteworthy enforcement cases. Turning to the program statistics for 2024 and 2025, last year was a particularly busy year for the PCAOB's enforcement program. The board issued 51 public orders, all involving settlements with registered firms and associated persons. Consistent with prior years, about 40% of the board's orders involved non-U.S. auditors, and 2 of the auditors involved China-based firms or their associated persons, disciplinary actions that were directly attributable to the historic access the board gained in 2022 to investigate and to inspect China-based firms. Also, and I'll talk about this subject a little bit more later, 5 of the orders involve charges concerning what I just referred to, exam misconduct, that is, improper answer sharing among auditors on internal firm training exams. And turning to this year, the first quarter has been busy for the enforcement program as well, with the board issuing 19 additional settled orders, 12 of those involving non-U.S. auditors, and 1 of those involving improper exam sharing. This next slide shows the steady upward trend in board enforcement orders and civil money penalties over the last 4 years. And importantly, as Chair Williams noted earlier today, these penalties are not only designed to deter wrongdoing and to protect investors, they also serve to benefit current accounting students. Last year, the board awarded $15,000 scholarships to more than 650 students. We have our first CPE code. The number is 213. That's 213. CPE code 213. Turning to the range of potential sanctions, there are a host of sanctions available to the board in addition to common sanctions that the board imposes, such as monetary penalties, suspensions and bars, and firm revocations of their registrations. I'd like to highlight the availability of other more forward-looking sanctions that the board can impose, such as practice limitations, undertakings related to training or changes in firm policy, and the appointment of either an independent monitor or an independent consultant to help firms improve their quality control policies and procedures. We've seen the board impose these more forward-looking sanctions more frequently recently. In enforcement and recommending sanctions, we really strive to tailor the sanctions to the underlying misconduct that we've identified. So, for example, we might recommend a practice limitation prohibiting an auditor from working in a particular area or in a particular role if that auditor has committed violations while performing that role in the past. Similarly, for firms, we might recommend remedial undertakings if a firm has quality control deficiencies in a particular area. However, if there are widespread quality control deficiencies, that's a situation where we might recommend that the board require the firm to retain an independent consultant or an independent monitor. I want to talk for a second about the effect of suspensions and bars on associated persons for firms. It's critical to understand the effect of these suspensions and bars, as some firms and individuals have been sanctioned for allowing a suspended or barred individual to, in the future, associate with that firm while the individual is still suspended or barred, and likewise the individual, if he or she engages in that misconduct associating with a firm while suspended or barred, those individuals have also been sanctioned. It's also important to note that in addition to associating with registered firms, it's unlawful for individuals who are suspended or barred by the PCAOB to associate with issuers, brokers, or dealers in an accountancy or a financial management capacity, or for issuers, brokers, or dealers to allow that association. Turning to the program outlook for the future, it's really similar to what the outlook or what the history of the program has been for the last several years. We continue to prioritize in enforcement investigations that involve significant audit deficiencies presenting risks to investors, matters that threaten to erode the integrity of the board's regulatory oversight processes. Those matters are typically instances in which firms or individuals fail to cooperate with a PCAOB inspection or a PCAOB investigation, most frequently by improperly altering documents in advance of an inspection or in advance of an investigation or during an inspection or investigation. We also focus on any significant independence violations that we see. In addition, more recently, the board has redoubled its focus on deficiencies in firms' quality control policies and procedures. As we'll see later, there have been a number of board enforcement orders involving QC violations. Also, we always focus on new and evolving issues that pose risks to investors. With respect to quality control in particular, as you know, firms have a responsibility to ensure compliance by their personnel with professional standards, and a proper system of quality control provides reasonable assurance that personnel will comply with those standards. During 2024 and 2025, the board has issued more than 40 orders involving firms that have engaged in quality control violations. Those matters have involved both non-U.S. firms and U.S. firms, and the orders have included all aspects, all elements of the quality control requirements, including independence, integrity, and objectivity, personnel management, acceptance and continuance of clients and engagements, engagement performance, and monitoring. And later I'll talk about one of those matters that the board issued a settled order in recently. We now have our first polling question, and this relates to the exam misconduct that I have referred to, improperly sharing answers on internal training exams. And the question is, what types of exam misconduct in professional training or accreditation have been identified in public enforcement orders issued by the PCAOB? And please choose all that apply. A, firm personnel sharing answers to training exams through emails, texts, and instant messages. B, the use of software applications to automatically input correct answers in the training exams. C, the use of software applications to automatically input trial and error answers to the training exams until the correct answer was selected. D, firm personnel taking training exams jointly and discussing answers with others. And E, firm personnel making training exam answers available to others through shared drives or servers. So please input your answer, selecting all that you believe apply. So selection A was the most frequently chosen. In fact, the board has issued orders in all 5 of these areas. In multiple orders, the board has sanctioned firms for failing to identify that their personnel were cheating on internal exams through sharing emails, texts, and messages with exam answers. In 2 China-based cases, a PwC China and PwC Hong Kong case, the board identified that firm personnel were using software applications to either input the correct answers or to input answers until the correct one was selected. With respect to jointly taking exams, the board has issued multiple orders, including ones against KPMG Netherlands, PwC Canada, and others. And then in multiple cases as well, firm personnel were using shared drives to cheat on the exams. Staying on the topic of exam sharing, this area continues to be a focus of the board because the board continues to identify this misconduct. As Chair Williams has said, the PCAOB will not tolerate cheating or other unethical behavior at PCAOB-registered audit firms. To date, the board has sanctioned 10 firms for quality control violations regarding exam misconduct or improper exam sharing, imposing more than $39 million in civil money penalties. All of the firms sanctioned were U.S. members of non-U.S. members of global network firms. And in each case, the exam sharing was widespread among firm personnel. The KPMG Netherlands order was sort of the most egregious misconduct that the board has identified, and the firm agreed to pay a $25 million penalty for its misconduct. The KPMG Netherlands order was one of 3 issued on the same day last April involving improper exam sharing. And KPMG Netherlands misconduct, though, went far beyond those of the other firms that the board has identified as having engaged in this misconduct. During the PCAOB's investigation of the PCAOB Netherlands matter, the firm repeatedly submitted false representations to PCAOB investigators, claiming that it had no knowledge of answer sharing, even though certain individuals who were responsible for making those representations had themselves engaged in answer sharing. One of those individuals was KPMG Netherlands' former head of audit, Mark Hogeboom, who, as a result of his misconduct, was permanently barred from associating with a PCAOB-registered firm and was imposed a fine of $150,000. We have our next CPE number. It is 986. The CPE code is 986986. Turning to the topic of coordination, the board coordinates its enforcement efforts with the Securities and Exchange Commission and may share information with the SEC, with the Department of Justice, and other agencies enumerated in the Sarbanes-Oxley Act. Coordination with the SEC is standard practice for us in PCAOB enforcement, and that coordination may result in parallel investigations where the SEC looks at the issuer and the issuer's personnel, and the PCAOB looks at the auditor. Or the cooperation may result in circumstances in which the SEC defers the auditor investigation to us, or we defer the auditor investigation to the SEC. The PCAOB has also negotiated cooperative agreements with audit regulators in foreign jurisdictions to facilitate the collecting of evidence, sharing of information, and the charging of respondents. Some of our foreign investigations also involve parallel investigations where we look at potential violations of PCAOB standards and other U.S. regulations, and the foreign audit regulator looks at potential violations that they have the responsibility for enforcing. Many PCAOB cooperative agreements can be found on the PCAOB's website at the International tab of the website. The cooperative agreements help provide us access and allows the board to continue to expand its global reach. Since its inception, the board has taken enforcement actions in 25 different countries on 6 continents. Last year alone, the board issued disciplinary orders against auditors in 13 non-U.S. jurisdictions on 5 continents. The last area I wanted to touch on was to talk about certain recent noteworthy settlements. I'll talk about 4 matters in particular. The first one is the matter of Halperin Illinat CPA and Illinat Halperin. That matter involved the Israeli firm Halperin Illinat and its sole owner. The matter involved widespread violations of PCAOB standards in 5 audits of 3 different issuers, including the failure to obtain sufficient appropriate audit evidence in multiple areas, the failure to conduct engagement quality reviews at all, failing to make certain audit committee communications, and as well as documentation failures and form filing failures. These widespread violations demonstrated the ineffectiveness of the firm's quality control system. As a result, the firm's owner was barred from associating with a PCAOB registered firm for at least 3 years, and the firm's registration was revoked for a similar period. The board also imposed a $200,000 civil money penalty on the firm and its owner jointly and severally. The next matter I wanted to talk about was the Malone-Bailey matter. It is the quality control matter that I referred to earlier. Last May, the board sanctioned the firm, finding that from 2018 through 2021, PCAOB inspectors repeatedly brought concerns to the firm's attention related to significant deficiencies in various audit areas, including auditing accounting estimates and testing of revenue, and that PCAOB inspectors also raised concerns about the firm's quality control system. Despite the firm's awareness of deficiencies and concerns in those areas, the firm failed to make effective changes to improve its system of quality control, as indicated by repeat and significant inspection findings in 3 consecutive inspections. As a result, the board required the firm to retain an independent consultant to make recommendations concerning the firm's quality control system and required additional training for firm personnel, and the board imposed a $400,000 civil money penalty on the firm. The next matter I wanted to talk about is one involving, again, exam sharing misconduct. Last April, the board issued an order against the Navarro Amper firm, which is also known as Deloitte Philippines. There, the firm's former national professional practice director, who was also responsible for e-learning compliance at the firm, repeatedly shared answers to internal training exams with all of the other partners in the firm. As a result, the board fined the firm $1 million and barred the former NPBD for at least 3 years and imposed a $10,000 civil money penalty on him. The size of that civil money penalty took into consideration the financial resources of the individual. Our final CPE code is 444. That's 444, the final CPE code. The last matter I wanted to talk about is the Rains and Fisher matter. This was a matter involving extensive non-cooperation by the firm with the PCAOB inspection, or actually 2 PCAOB inspections. In anticipation of those 2 inspections, the firm and its personnel modified numerous work papers after the documentation completion dates for 3 different engagements. To hide its misconduct, the firm and its personnel changed computer clocks and printed documents to PDF. The engagement partners for the audits were principally responsible for the misconduct, but the managing partner at the firm was also aware of the improper alteration of work papers, but didn't do anything to prevent the provision of those work papers to PCAOB inspectors. The matter also involved a failure by an engagement partner in a carrying broker-dealer audit to comply with certain auditing and attestation standards, and a failure by an EQR partner across 7 different BD audits to perform appropriate engagement quality reviews. As a result of this misconduct, the firm's registration was permanently revoked, and the engagement partner received a 5-year bar, and the EQR and managing partner received 3-year bars. As these sanctions indicate, the board takes very seriously non-cooperation with an investigation or an inspection. Our last polling question relates to the scholarships I referred to earlier. The Sarbanes-Oxley Act requires monetary funds collected by the PCAOB as a result of enforcement actions to be used to fund scholarships for accounting students. The question is, for the 2025-26 academic year, about how many schools are eligible to nominate a student to become a PCAOB scholar? A, 100, B, 250, C, 400, or D, 500? If you could input your answers. Give it a few more seconds. Most people picked A. No, I'm sorry, most people picked D, the correct answer. That's right. More than 500 schools are now eligible to nominate someone to become a PCAOB scholar. I will end by pointing out information about the board's TIPS line. The TIPS line is an important facet of our work to protect investors. If you have a tip or referral, we encourage you to reach out through any of the methods identified on this slide: email, regular mail, or by phone. The PCAOB Tips and Referral Center can also be accessed from the landing page for enforcement on the PCAOB website. And I think we are just out of time now, so if people in the room have questions afterwards, I'd be happy to answer them. But thank you for your attention and for attending today.